Last week saw the release of the November FOMC meeting minutes. During their discussions, participants judged that the current stance of monetary policy was restrictive, putting downward pressure on economic activity and inflation, and also that financial conditions had tightened significantly in recent months. While both 2- and 10-year yields have since eased back from their October highs, they remain respectively 60 and 80 basis points above the average of the first half of 2023. With inflation decelerating at a rapid clip, arguably the change in nominal yields underestimates the severity of the tightening the US economy is experiencing, particularly if assessed using actual inflation rather than expectations. Importantly, this trend has further to run, with the disinflation expected over the coming year to increase real yields by another 100 basis points if nominal interest rates do not fall. The change in credit conditions brought about by 2023's bank closures and associated regulatory reform are also yet to fully impact business and households. Apparent in the October edition of the Federal Reserve's Senior Loan Officers Survey is that more than a third of respondent banks tightened lending standards for commercial and industrial loans to the middle market and large firms in the 3 months to October. Roughly half also reported increasing credit spreads. Households have not been materially affected by a change in bank lending standards or spreads, but the rise in base rates has already seen affordability fall to historic lows. The combined effect of these developments on credit growth is becoming entrenched. 6-month annualised credit growth for large banks having recently fallen below zero from almost 13% back in August 2022. The peak for smaller banks came at the end of 2022, but the deceleration since has been equally dramatic. In thinking about the implications for activity growth, it is critical to recognise credit growth deceleration is occurring at a time when household income growth is also coming under pressure. Nominal wage growth is running at a similar pace to inflation, limiting the recovery in real wage rates. Hours worked are down over the year, while the household survey and business indicators are increasingly pointing to a stalling out of job creation or possibly a period of retrenchment. It is for these reasons that we remain of the view that the US economy is entering a lengthy period of below-trend growth to end 2025. Stopping the economy from stalling or falling into recession, in our view, is continued success with inflation and active policy easing by the FOMC from March 2024. With the savings of median Americans having been materially reduced, and those in the upper income deciles investing surplus funds for the long term, lower inflation and interest rates and a still strong labour market are necessary to avoid recession and set up a return to trend growth beyond 2025. Looking to the medium term, it is also worth highlighting the additional risk the US's poor fiscal position poses. With the federal deficit currently running at around 6% of GDP, even with historically low unemployment, above average nominal wage growth and interest costs yet to reset, there is a significant risk of a larger term premium being priced into US Treasury yields and greater uncertainty over credit spreads. Such a deterioration would offset some of the benefit offered to the economy from success with inflation and returning policy near neutral, prolonging the period of weakness beyond 2025. We'll see you next time.